When people hear the word investment income, they often assume that it all works the same way, but it doesn't. Different types of investment income behave differently and are generated in different ways and can even be taxed differently. Understanding these differences is a key part of building financial awareness. Welcome back. I'm Cecilia Nelson with Nelson Wealth Strategies, where we focus on breaking down financial concepts so they're easier to understand and apply thoroughly. And I do mean thoroughly. Today's video is all about the different types of investment income and what they are and how they are generated and why knowing the difference matters. Number one, what is investment income? Investment income refers to money generated from investments rather than from wages or business operations. Unlike a paycheck, investment income comes from multiple sources and it doesn't always arrive on a regular schedule. To keep things simple and sum things up, investment income is just one thing. It depends on how money is invested. Moving on. Number two, interest income. The first type of investment income is interest income. Interest income is earned when money is lent out, either directly or indirectly. A common example would be bonds, saving vehicles, certain fixed income investments. In simple terms, interest is compensation for allowing someone else to use money for a period of time. An important concept to remember is interest income is typically more predictable and payments are often scheduled. Here's a real life example. Let's say you purchase a U.S. Treasury bond with a face value of $10,000, a coupon rate of 4%, and the maturity of 30 years. Here's how the interest works. Because a Treasury bond pays interest every 6 months based on the coupon rate, the annual interest is 4% times 10,000, which equals 400 per year. So since T-bonds are paid semi-annually, your interest payments will be $400 divided by 2, which is $200 every 6 months. Yep, $200. You will receive that as interest income every 6 months, regardless of market price changes. Well, unless it gets called, but that's a different video. Anyway, if the bond is not called, you will receive $200 every 6 months for 30 years, along with your principal, which is $12,000 in interest payments and your recuperation of the original $10,000 of principal. Side note. Treasury bond interest is taxable at the federal level and typically exempt from state and local tax. So looking into these kinds of investments, it's important to consider the tax implications and other risks associated. Number three, dividend income. Another common type of investment income is dividend income. Dividends are payments that some companies make to their shareholders, typically from company profits or retained earnings. When you own shares of a dividend-paying stock, you may receive a portion of those profits simply for holding the stock. Dividend payments can be paid quarterly, which are the most common, monthly, which are less common, and lastly, dividends can be paid irregularly or as special dividends, which are the most uncommon because they are often a one-time non-recurring cash payment by a company to a shareholder due to a major financial event. A famous example of a special dividend was in 2024, where Microsoft paid a dividend of $3 per share for a total of $32 billion. Its normal dividend was 4 cents a share. So don't bet your life savings trying to predict the next special dividend for a company. They're very rare and happen occasionally. Speaking of amount, another thing to consider with dividend income is the amount you receive. Depends on how many shares you own, the company dividend rate, whether the company increases, reduces, or suspends its dividend. An important thing to realize is not every company pays dividends, and even for some companies, that pay of the dividends aren't necessarily always guaranteed. Growth companies often reinvest profits back into the business instead of paying dividends. An example of growth companies are Google, Tesla, Amazon. Dividend-paying companies are often more established and generate consistent cash flow, and we like to call them value companies or value stock. An example of value companies are Coca-Cola, Walmart, and Procter & Gamble. Lastly, another thing to consider, even for companies that do pay dividends, dividends are not guaranteed. Payments can increase, decrease, or stop entirely depending on the company's performance and economic conditions. Number four, capital gains. Capital gains are another major category of investment income, and this is where many people get confused. A capital gain occurs when you sell an investment for more than you originally paid for it. Until the investment is sold, any increase in value is considered an unrealized gain. Now, I know some of you probably are asking, what in the world is an unrealized gain? An unrealized gain is an investment that you still own that you have not yet sold and turned into a realized gain, which is an actual profit because you locked it in. And unfortunately, when this happens, you do get taxed as well. And how you get taxed on these capital gains also depends on how long you hold them as well as before selling, which are short-term capital gains versus long-term capital gains. Short-term capital gains are investments held for 1 year or less and are generally taxed at ordinary income tax rates, which are often higher than long-term rates. Long-term capital gains are investments held for more than 1 year and are generally taxed at a lower preferential tax rate, which are designed to encourage long-term investing. Capital gains come from selling stock, bonds, ETFs or mutual funds, real estate, businesses, or other assets. Number 5, distributions from funds. Lastly, it's important to understand that a single investment can generate multiple types of income. Investment funds, such as mutual funds, index funds, and ETFs, often hold many underlying investments inside of one fund. Because of this, income can flow to investors more than one way. Funds may distribute income that comes from interest income, which are from bonds or cash holdings inside of the fund. Dividend income can be from dividend-paying stocks held by the fund. And capital gains. That comes from when the fund sells investments at profit. These payments are called distributions. Number 6, why different income types matter. Understanding the type of investment income matters because each type behaves differently. Some are more predictable, some fluctuate, and some depending on the market, timing, or business performance. Some things to consider depend on your needs, which can be timing of income, predictability, tax treatment. This way, awareness helps reduce surprises, and especially at tax time. One common misconception is assuming that all investment income is treated the same. Another is expecting investment income to behave like a paycheck. In reality, investment income can vary widely depending on the structure and market conditions. So keep that in mind before using investment income as a primary income. Understanding how investment income works, whether it's interest, dividends, capital gains, or fund distributions, help you make more informed decisions and avoid surprises along the way. If this breakdown helped clarify things for you, be sure to like, subscribe for more educational content, and share with someone who you think could benefit.